Okay, I'm going to pull this out. Everybody hear me all right? If it gets too loud, I guess you'll know it. So if I get too soft, you can't hear me, let me know. And I'll try not to stutter as I speak. Okay, let's make sure. All right, excellent. All right, well, thank you all. Thank you for that introduction. Thank you all for having me down today. It's a privilege to be here. I have to say, it's always welcome to be able to speak to a large crowd as an economist, because sometimes, economics is known as the dismal science, and so if you see that an economist is going to be your keynote speaker, you think, well, maybe I'll pass on this event. So, but it's very nice to be here, and I'm glad that you all were able to come out and make it today. So, what are we going to talk about? Well, as I said, my name is Nessen, and I do work both for the University of South Carolina and for Resh Marketing. And because of that, I think I have an advantage in looking at the market because I'm lucky enough to be able to have a foot in both areas, both in the private sector and in the public sector, in a large university in a research capacity. And I work in the division. I do all the housing research that the division of research releases, in addition to regional forecasting and some economic impact studies throughout South Carolina and throughout the Southeast. And then Resh Marketing, we specialize in marketing research, and we do marketing and advertising really from the ground up, and Resh has been around for about 30 years. So that's a little background about me. So today we're going to talk about South Carolina housing market and what's coming next. So the way we're going to outline the talk today is first we'll look at the national economy and see what's going on. Then we're going to focus on the tax credit at a national level, see how that's impacted the housing market, and see what the expiration means for us. And then we'll move into South Carolina, look at different regions of the state, and then finally look at how the nation and specifically how our state is adjusting to current market conditions, to the expiration of the tax credit, and where I see us going forward for the remainder of 2010. Okay, so let's start out with the national economy. And really the best way to get started is to look at GDP. It's everybody's favorite statistic. It's the most commonly cited statistic, and it's also the single best indicator we have for overall economic performance, gross domestic product. So here you can kind of get a sense of where we've been for the last 9 or 10 years, going back to 2001, and you can clearly see the recession of late 2008 and 2009. But in the beginning of the third quarter, the second half of 2009, we began to see some rebounding in GDP growth at the national level, which is very good news in terms of recovery from the recession. You can see here that in the first quarter of 2010, GDP grew by 3.2% at an annualized rate. And what that means is that if GDP were to grow for 4 consecutive quarters at the same rate that it grew in the first quarter, we would see 3.2% growth. So whenever you see an annualized rate, that's what that means. But in terms of pure growth rate, we've seen about a 2.8% increase since July of 2009. And we should see about a 2 to 3% annualized growth rate for the second quarter, and I believe that number comes out actually tomorrow morning. So you'll probably see that on CNN.com or whatever news outlet that you look at. All right, so then let's take a look at, there we go. Let's take a look at the components of GDP. Because when we look at GDP, it's important to realize that there are several ways that figure can actually increase. The two that tend to drive it are consumer spending and private investment. We also have government spending that's a component of that, as well as net exports. Now, the important thing to realize is that when we got back to our recovery in the second half of 2009, one of the problems with that is that we were seeing consumer spending and government spending as being the two factors driving that growth. The problem is that when we look to government spending to create long-term GDP growth, that can't happen. It's got to be the private sector that drives it. And so that was a concern going forward in the latter half of 2009, and that we've seen this substantial increase in government spending, really 5.6% since 2008 as a percentage of GDP. And here's a better perspective too, that's increased since 1990, and specifically since around 2005. So it's projected to be as high as 44% in 2010. So then if this is what we're looking for, if consumer spending and private investment is what we're looking for, how are those numbers shaken out? Well, it turns out that consumer spending has actually been doing very well since early 2009, which is really when I see us as having hit bottom in terms of the housing market. That's when we were lowest in terms of sales activity and housing starts. So if we measure it from 2009 onwards, consumer spending has been rising. It's risen 2.7%. It rose that much in 2009, and it's projected to be up throughout 2010. You can see that we're on an upward trend here. More importantly, if we actually look at U.S. gross private investment, that number has finally started to take off. And this is exceptionally good news for the national economy, because it means we're having to rely less and less on any sort of fiscal stimulus, any sort of government spending. And this is very important in terms of overall economic growth long term. So this is very important that this has finally turned around. It's at 13% so far in 2010, and it's being projected that that will continue through the rest of 2010. So when you're looking at GDP, it's important to look at those functions, or look at the components of GDP, because that's very important in terms of long-term growth. One other statistic that you can look at to sort of get a sense of confidence in the market and where we're going is the Dow Jones. It's looking at the stock market. It's currently hovering around 10,000. You can see that with some seasonal fluctuations since early 2009, it's really been increasing steadily, which is also good news for the national economy. Okay, so that's the perspective nationwide. That's what we're looking for, especially that will help you interpret some common statistics that you see coming down from different news outlets. So let's talk specifically then about the housing market, and specifically about the tax credit. I apologize for pushing my button right up here. Okay, let's look at U.S. housing starts. So this goes back to the last 50 years. And here you can see rapid fluctuations in the market. But notice here, when you're trying to get a sense of a long-term perspective, from 1990 until we got to the housing bubble about 2004, notice that there was what I like to call slow and steady growth. So we had a slow and steady growth rate of housing nationally, and this is the case in South Carolina as well. We'll get to that here shortly. And then, of course, we had the problem in late 2008. But since then, beginning in 2009, we've seen housing starts rise. They're up 9% from July to December of 2009. We've seen an increase of 25% year over year from January 2010 to January 2009, and then up 10% just from January 2010 to May 1st. Now, something changed on May 1st, and what was that? The tax credit. So we've actually seen some erosion there. I think we've down about 8% since May 1st, rather. So, the question is, what are the effects of the tax credit? Why was this a good thing? Well, there are several reasons this was a good thing. First of all, it really helped a lot of local housing markets throughout the country to stabilize. So we were seeing constant declines in starts, constant declines in housing sales, and the tax credit was able to stabilize a lot of those markets and create an into that slide, sort of create a bottom, if you will. That sounds kind of bad, but we have to get to the bottom before we can move back up. So that's one thing that the tax credit did for us. Secondly, what we saw recently, especially here in South Carolina, we saw jumps in sales. We had unprecedented 1-month growth rates in sales in terms of new sales and resales. And during March and April, as buyers flooded the market to try and take advantage of that tax credit before it expired. So, what do we do now? What's going to happen now that the tax credit has expired? Well, one thing that we've looked at is what is going to be the impact of the tax credit expiration nationwide. And what we're forecasting is that there's going to be about a 4% decrease in housing starts as a result of the expiration of the tax credit in 2010. That is based on the fact that now that the tax credit has expired, what does that mean for all buyers? Effectively, they're seeing a price increase across the board for new home buyers, right, of around $6,500. That's what this estimate is based on. Now, the National Association of Home Builders is forecasting about 703,000 housing starts for 2010 nationwide, and so 4% of that means that about 28,000 of those will not be realized. The good news is that that is actually a high estimate. So as the economy continues to recover, and I'm going to show you some other statistics that will give evidence of that's going to mitigate some of that loss. And so while this is a really upper bound on that estimate, as the economy continues to rebound, as we continue to move on to 2010, we're likely to see this not to be this figure quite so high. But you have to remember, anytime an economist or anyone makes a forecast, they're doing that based on historical data. And when they do that, that means all things the same. So for the rest of 2010, it's just like